Welcome to Bloomberg ETF IQ Europe. I'm Matt Miller. Over the next 30 minutes, we'll be your guide to the region's thriving market and exchange-traded funds. Everything you need to know about the funds and the flows. Bumper inflows. European ETF assets soar past 1 trillion euros as fees continue to fall. We'll discuss where the industry is headed in 2021. A deal is done, but not on London's financial services. We'll ask if Europe's most important ETF hub will continue to thrive and prosper outside of the EU. And as investors continue to try to catch crypto FOMO, will regulation dampen the Bitcoin party? We've got a new record, more than 28,500 euros. European ETF assets soared past €1 trillion in 2020 as cash flowed into equity funds on vaccine optimism. Globally, Bloomberg Intelligence reckons exchange-traded products could take in more than $1 trillion in 2021. Let's get a quick thought from Paul Markham from Newton Investment Management. Paul, ETFs have been soaring in popularity. How do you see that playing out next year?
Well, I think that the positive development here, Matt, is that the active ETF market is growing. And that's something which should be to the benefit of active managers. So historically, we've seen them used really for portfolio management purposes, for passive style investment. But active ETFs will be a big growing market. And that means that more choice will be available to investors. And I think that can only be a good thing as regards, firstly, the products available to underlying buyers, but also the fact that the asset or capital allocation, which is the point of markets, is respected on a more discerning basis.
All right, we're going to get more from Paul Markham in a moment. Right now, I want to get to Brexit. It's only been 4.5 years. Now the EU and the UK have agreed a trade deal, but it's a trade deal that does not include services, leaving the City of London to face the new year with more uncertainty. Let's get some analysis with Bloomberg Opinion's Marcus Ashworth. So, Marcus, how has this uncertainty affected London's ETF industry?
Hi, Matt. Well, I mean, I think it's certainly held back the growth that looks great in ETFs, and I think it will continue to be, principally because there's some further Financial Conduct Authority changes to the MiFID II regulations, whatever, which is going to make costs more visible, which only is going to benefit further ETFs. But that aside, Brexit has held back the growth because of uncertainty. A lot of the UK, in particular, ETF market gets used by fund managers as a sort of low-cost, short-term hedge, passive, just building market exposure and taking it on and off without really a long-term commitment to, perhaps as indeed from a retail point of view. Again, we see probably big companies like Vanguard going to come and take on the big one here, which is BlackRock, into the retail market. I think that'll spill over into helping ETFs. But once Brexit has been theoretically sorted out, as we look like it is going to be, it's only going to take away that uncertainty, and that can only be good, specifically for UK exposure. And if you're an outside investor or even a domestic investor, you want to get exposure to UK. What's the quickest, simplest, easiest way to do it? Logically, it's going to be ETFs, and I think more will be created to enable people to take, Brexit basket risk.
What are the main Brexit-related challenges facing the wider financial services sector, Marcus?
That's a loaded question, whoever that was. Well, I mean, literally, the EU, understandably, wants to take back control of its own financial services sector, of which it's never really got its act together properly. Look, the UK has massive advantages from language, from its legal code, and indeed from the massive infrastructure here. Nonetheless, there is a real desire for Europe to get control of its own markets, and that's something which is going to ebb and flow. And certainly on a regulatory basis, it's clear that Europe is going to put some firmer rules in place to encourage investment banks in particular, and then fund managers as well, to have to do euro trades in Europe out of European stocks and bonds. But that's going to take some time to get through. We all know already that the derivative side of clearing will not be affected until the middle of 2022. I expect with the financial services side agreement, if we get this positive effect from this deal and it sticks and looks like people are both sides are happy with the way it's going, then I think we might get something more substantive on financial services by March, April. Well, we know two things have been included in this deal. One is this thing called the head note, which means that consultancy services can be sold on UK entities, and the centre won't restrict that. And the other thing is that there won't be cross penalties. So if there's a disagreement on fish, it doesn't mean that the EU will be able to restrict UK finance. So there are some promising prospects for a deal to be done. It will. Go on.
I was just going to point out, Marcus, maybe the deal is the EU takes back full control over its financial services, and then the UK, in return, gets total control over its fishing waters. Does that make sense?
Well, that's what's called a no deal, and bear in mind there's a one-year ripcord on this. That may well end up being the case if this doesn't go well. But, I mean, practically speaking, both sides need each other. And we know how important it is for the UK. It's 7% of GDP, our biggest export. We are the largest financial services exporter in the world. Nonetheless, the EU is totally reliant, effectively, on the City of London for raising finance. And that's something which is going to become more apparent, I think, in the next few months. And that's why I think there's a bit of grown-up approach from both sides. It might help.
I mean, financial services is pretty important to London, but fishing is super important. Marcus Ashworth, thanks so much for joining us from Bloomberg Opinion. Paul Markham from Newton Investment Management is still with us, joking around obviously a little bit there about fishing, but how can you not? What do you expect in terms of the status of the City of London throughout 2021?
It's a great question, Matt, because we saw the banks perform quite weakly yesterday in light of the lack of inclusion of financial services in the trade deal. And that's something which will be quite close to home, because financial services institutions make up the City of London and make the vast majority of decisions around investment in stocks, bonds and currencies in it. So that is something which will continue to be an overhang. I think that what we heard just then in your previous segment regarding the infrastructure, not only the systems and legal framework, but also accountants, lawyers, skilled staff, all of those things take many years to build up, and that's something which London will see quite rightly as a bit of a moat, but it won't be complacent. The desire to move to other European cities on the part of some of the European nations is very high, particularly Paris, to some extent Dublin. They really want to see more of that business on their doorstep. So it's something which will pan out over several years. So I think the desire to get something done quite quickly and included in the scope of the deal will be very strong on behalf of the UK government. The EU heads of state, however, may be a little bit more demanding regarding how that particular provision is included. So it will be a moving feast, I think, but the UK government will want to get that on the agenda as soon as possible.
Paul, can I just ask quickly, what's it going to take to get back to gains on the FTSE? We're still down 12% year to date on UK stocks, and everyone said, it's such an international index, it won't be affected by Brexit, but it seemingly has.
Yes, absolutely. And the thing to remember, of course, which is a little bit of a conundrum, is the fact that 70% of FTSE 100 revenues come from outside the UK, and sterling's been weak. So, in a sense, the fact that it's been such an underperforming market despite all of that is disappointing. The sector breakdown of the market is important. There's a much lower technology weighting than certain other major markets. There's a higher weighting to oil, which has clearly been a sector with many challenges. Big area in mining. Again, both of those have weaker ESG credentials or weaker perceived ESG credentials, and that will be a headwind going forward. And of course, we've also still got a reasonably big banking sector, which has been a negative Brexit beneficiary, if you like. So that's been a tough aspect of it as well. I think we'd need to see evidence that UK economy, firstly, is starting to thrive or prosper or not be as badly affected by Brexit as the market has expected, and that will benefit the domestics. And then, of course, we will need to probably see the global economy increase, because the UK market is very much seen as a bellwether for the global economic situation and outlook as we see it at any given stage. So really, global recovery will see the FTSE be quite a levered play on that, I would imagine.
Paul, thanks so much for joining us today. Paul Markham there from Newton Investment Management. Coming up, as investors continue to catch crypto FOMO, will regulators dampen the Bitcoin party in 2021? We'll discuss that next. This is Bloomberg. This is Bloomberg ETF IQ Europe. Everything you need to know about the funds and the flows. I'm Matt Miller. Bitcoin has made all kinds of records lately, crossing the $20,000 mark and then $25,000 just days later, $28,000 on Sunday. In Europe, crypto ETFs have been taking advantage. Simone Foxman is watching the investor frenzy. Simone, what's the scale of the European crypto market?
Well, Matt, a year ago, we were at less than 1 billion euros of crypto exchange traded products. Now, the top 4 crypto exchange traded products, well, they're worth about 2 billion euros. This, of course, led by Bitcoin Tracker EUR. That's based in Sweden, and that is the largest crypto exchange traded product around the world. But in fact, there are 6 products that all have more than 100 million euros apiece. Those are based in Switzerland, Germany, and in Sweden, Matt.
All right, Simone, thanks very much. Simone Foxman there talking to us about the big Bitcoin run-up. Let's round off an eventful year by hearing from some of our recent guests. They gave us their predictions for 2021's investment landscape.
We see investors both on the institutional side as well as in the wealth management side needing to have more ESG solutions. So I think that's where a lot of attention is going to be. But I think the other side, if we look at equity still, is there are definitely opportunities which are still undervalued. A lot of the movements this past year has really been on the large cap stocks, and some of the mid cap and small cap opportunities are often not seen with the same kind of lens. So I think there's going to be a lot more focus in the new year on that. And I think that's where a lot of times the thematic portfolios that we certainly look at, that's where we see the attention and where some good value can be found.
It's very clear what's worked in 2020 have been technology-focused thematic investments that touch on software in various ways. Cloud computing, for example, is up basically 90% year to date. So in less than a year, during a global pandemic, you have a diversified investment strategy of 54 stocks up almost 100% year to date. It's crazy to consider that, but that's what we've just seen. Now, going forward, we know that the world is still focused on data and generating data, collecting data, regulating data. It's in the news every day. And things that focus on cybersecurity and privacy, we think are going to be very interesting, especially with potential for new regulations along all this continued collection of data. We see artificial intelligence as the toolkit that allows people to actually make sense of all the data, at least somewhat, that's being collected.
This is a bit of a sugar rush towards the end of this year. Clearly, what was different actually between Europe and the US is that the flows into value in terms of into cyclicals, into risk-on type of trades really came late in the game, just after the vaccine announcement, really. So for all of the buckets of risk-on trades, it's been filled with in the past months or past 5 weeks now. 2021 might be a bit different. I think the expectation for returns might be lower. The good thing, though, is that bond performance is expected to be even lower than that, so that still gives a little bit of a signal to be positive risk assets, equities. There will be some pockets of value to be found.
Another big change is China, Chinese bonds. So people are looking for yield, And with FTSE and Bloomberg deciding to put Chinese bonds into their indices in 2021, we're seeing significant increase in interest in those products. CSOP had a launch about a month ago with 645 million at launch. It got to over $1 billion in size within 2 weeks. So I think that emerging markets looking for yield, and you mentioned smart beta. I think one of the things we are seeing is a move away from smart beta, especially as companies have decided to pay out less dividends. Dividends used to account for about a third of smart beta assets and strategies. And so we're seeing investors move, as I said, more to ESG, more to thematics, and more to countries that they think will benefit from post-pandemic environments.
The ETF industry is only going to continue to grow. I think we've seen that trend line continue for quite a number of years now. And as more investors are looking for both simple investment solutions, diversified building blocks, that is really just highlighting the fact that the ETF industry is going to continue to grow, not only just in the equity space, but very much in the fixed income space as well.
One of the fastest growth areas for next year and for the coming 2-3 years, there's only 44 fixed income ESG in UCITS out of over 400 overall fixed income ETFs. So there's a lot of work to be done. We've had about 7.5 billion of inflows this year to date. Last year, there were only 2.5 billion of inflows. So we've tripled the flow rate into this area, and I think going forward, we can see that multiplier even go higher.
I do think that ETFs will continue to grow. I'm seeing investors, in Latin America and Asia, across Europe, using the UCITS ETFs that are domiciled here. And I think that regulatory changes in Brazil, the biggest market in Latin America, where they're going to allow Brazilian depository receipts on foreign ETFs, is a big opening up of that market. We've seen investors in Mexico, Chile, Peru embracing UCITS products, especially as core holdings. They tend to use US listed ETFs more as tactical sleeves. And I think if you look at changes in Hong Kong and Asia, you're seeing a greater adoption of using UCITS, especially with the feeder funds that have changed regulations, where the local regulator in Hong Kong now only regulates the feeder fund and not the primary listing. So I expect to see increasing use of UCITS ETFs around the world.
Some of our recent guests there looking ahead to the next few months. Coming up, ETF assets under management in Europe topped €1 trillion this year. But which industry players have done best? We'll discuss that next. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Matt Miller. It's been quite a year for news and quite a year for Europe's ETF market. Assets under management in the region topped €1 trillion as cash poured into equity funds on vaccine hopes. But which industry players have done best? Let's get more with Bloomberg's Simone Foxman. Simone, so who's on top this year?
Well, Matt, it continues to be BlackRock's iShares dominating 44% of the market in European ETPs, and it's not even close. The next biggest player, DWS, has about 10% of the market share, but lots of players coming after that. But this is a spot where we could see a huge shakeup because Lyxor's asset management business is for sale. Now, Lyxor, the third largest in terms of market share player in this space. But we've also seen lots and lots of new entrants continuing to pile into the market. Of the 53 ETP issuers in Europe, 16 haven't been around for more than 4 years. There were 4 new this year. Credit Suisse managing to amass more than 3.8 billion euros in assets in just that short time.
Plenty of fee cuts in 2020. Is that likely to continue in the new year, or will it reverse?
Well, Bloomberg Intelligence says yes, definitely likely to continue. More fee cuts ahead. Right now, there are only about 10% of the market 13% of the market that has fees of 10 basis points or less. That's quite a lot smaller percentage than what we've seen in the United States, where about 60% of products offer that kind of level of fees. And that's partly because the European market is fragmented, it's newer. It's also because a lot of the hot products this year, they've been the complicated stuff, the leveraged ETFs, the thematic ETFs that charge higher fees on those, but look, I think there's a lot of room for consolidation that we talked about, but we've seen this pressure towards low cost generally around the world. Consolidated players, the bigger players, they're the ones who are able to offer the lower fee products. I think Bloomberg Intelligence estimated that 525 million euros, that was the size of ETF that cut fees most quickly. And so we could see that trend continue as we get these larger products.
All right, Simone, thanks so much for joining us. Bloomberg's Simone Foxman there talking to us about the winners and losers of 2020 and what to expect in 2021. That's it for this week's Bloomberg ETF IQ Europe. We'll be back with more next Wednesday at 9:30 a.m. London time. This is Bloomberg.